Hello, everyone, and welcome to the Center for Creative Entrepreneurship's workshop. We are really excited about today, and I think that music was appropriate, right? It's like how we're going to be talking about raising funds, the mystery, with a lot of companies and entrepreneurs who are starting businesses. They're the biggest question that I get as working for a center that wants to support entrepreneurs is, how do we raise funds? So I'm really excited about the conversation and the presentation that we're going to be having today. My name is Daniel Crane. I am the program director for the Center for Creative Entrepreneurship. If you go to cceglobal.org, you can check out the work that we are doing. We are building resources, putting together events, online, virtual, and in person to support creative entrepreneurs in the Chicago area. Again, check us out at cceglobal.org. So without further ado, today's guest is Leslee Cohen of All Rise Legal Counsel, a law firm that does corporate securities, mergers, and acquisitions for entrepreneurs and their businesses. Leslee has successfully partnered with entrepreneurs, startups, and growth stage companies for 30 years in connection with their early fundraising rounds, whether friends and family investments, angel seed, or venture capital rounds. Her firm, All Rise, has a singular and insanely dedicated commitment to its client success. She not only knows the law backwards and forwards, but also has the long-time experience necessary to know market terms and which details matter most. As an added benefit, Leslee offers an extraordinary network of other talented people, which she actively opens to all of her clients. I'm very excited to have her today. Let's bring her into the conversation. Hi, Leslee.
Hello. Thanks for having me.
Welcome, and thanks for taking the time to talk to us today. I know that, in our initial conversation, learning about the work that you're doing, it's exciting to have you here and to be learning, about how to raise funds and kind of with your experience, what are some of the things that you have seen? If you don't mind, just give us a quick little background, and we'll jump right into the presentation.
Yeah, absolutely. So I started my career as a lawyer on Wall Street. I was doing deals for large publicly traded companies, initial public offerings, secondary offerings, and mergers and acquisitions for those large companies. And then I, 6 years later, moved back to Chicago, where I'm from, went to a mid-sized firm here, and spent 13 years doing the exact same thing, but for large privately held businesses and microcap publicly traded companies. And then just over 11 years ago, left to start All Rise, which had a different name in the past, but really to focus on working with smaller businesses. And so, at this point, fast forward to today, and we focus, and you alluded to it also in your intro, in 3 areas. So one is helping startups raise with their early round raises, fundraises, and helping them through that process. Second area is, okay, now we have money. So this whole business cycle. So, okay, we're new, we need to raise, go through that process. Now we have money, and we need help with our day-to-day contracts. So agreements with our vendors, with our with our customer agreements, SaaS agreements, license agreements, just any employment agreements, advisory agreements, day-to-day contracts you need to run your business. And third is M&A. So we're going to grow by acquisition, or, be really lucky and have a huge multi-million-dollar exit, and
Right.
everybody walks away with a real lot of money. So that's the that's the practice.
Yeah, absolutely. Well, let's get right into the presentation, and just let me know for next slide, and we'll kind of go from there. And I'll ask some questions, as I know, as working with entrepreneurs, kind of some of the things that they're curious about.
Yeah, absolutely. You can go to the next slide, please. So I'm just going to give you a quick overview. So the point of this presentation is to educate everybody listening in terms of, we're going to raise money, and we know that we need to do something on the legal end. And we've heard that there's this thing called a safe, and that's the most, typical way founders raise money, in the angel round or seed round. So like, do we just print that off? We heard there's this Y Combinator and you can find it on their website. And like, do we just print that off and give it to investors and take their money? Like, what do we do from a legal perspective? And you'll hear, some lawyers who are, at larger firms, and they'll say, oh my God, you're selling a security. You have to comply with all the securities laws. You're going to need a private placement memorandum. And we're talking about like $50,000 in fees, right? And you go, wait. Like, I'm a startup. I don't have that kind of money.
Right.
What are you going to do? And then you go to another lawyer who doesn't specialize in startups, who's maybe like a general business lawyer, does some trust and estates work. And he or she says like, no, this is not really selling a security. Print out that form and give it to your investors and you're fine. Right. So you're totally confused. And so really what the point of this presentation is to give you a layperson's explanation of the laws underlying all of this, so that you go into those conversations with your lawyer on an educated basis and don't feel intimidated by the process. Overviews up there. We don't have to spend time on it, so we can go on to the next slide. First thing I want to talk about, and I won't get too technical, Daniel. I'll let you ask the technical questions if you want me to go deeper into this stuff. But something I hear a lot of times is, should I raise from friends and family if I can find some people who have the money, or should I go to these angel groups and funds, more institutional kind of investors? And the answer is obviously there's good and bad to each one. So, friends and family, very often they're unfamiliar with this safe, which I'll talk about right after this, which is that, really the most commonly used tool, and for good reason, in terms of early stage fundraising these days. So, your friends and family very often will say like, what is this? I don't know what this form is. And the other thing is that they could be, and by the way, that increases legal fees a lot, because they'll give it to their lawyer who may or may not be familiar with it. And then you get into all of that. So that's one thing. The other thing is sometimes these people are not what's called non-accredited investors. And we'll get into that more a little later, but they're more protected. Non-accredited investors basically don't meet certain wealth and income standards. And so the government, the SEC, protects them more so. And so, you start and your later stage investors don't love seeing non-accredited investors on the cap table. So those are some of the downsides. Whereas the biggest upside with friends and family is you set your terms. And, you're raising from a whole bunch of different people. So you kind of put your terms out there and they can take it or leave it. So the flip side is, if you're going to these angel investors, serial investors, they're much more sophisticated. And so they will give you their terms for the most part. So that's more of a downside. The upside is they're well aware of what a safe is, and they can give you very often strategic advice and really be a partner. And that's really helpful. Unless you have any questions, we can go to the next slide.
Yeah, no, keep going. I will have some questions after the next one, but I want to hear that.
Terrific. So next. Okay, perfect. So there's really two kinds of securities that you use when you are selling a security, by the way, in response to that lawyer who may not know that. And there's two kinds of instruments or securities that are most commonly used in early stage fundraising. And the reason is, and these are convertible securities. And the reason that you use them is if you have your business and you go to, whoever your investor, and, they say, I'll give you $100,000. What do I get for it? Well, how do you put a value on your company when you're so early, right? And, so you don't want to give away too much. You don't want to give away too little. And there's really no valuation to your company at that point. So these are two convertible notes and safes are two ways of avoiding that whole having to put value on the company. And so what these instruments basically are, so it started like 10 years ago, it was all convertible notes. And it was basically your investor gives you $100,000 and you give them a promissory note. And it's, typically it's got, it's due in 1 or 2 years. It bears interest at 7 or 8%. But the point of it is that if you raise another round of capital or you sell your business before the maturity of the note, that note converts into your investor having the right to convert that note into shares in that next round. So let's say you're raising another round of capital, but they get a discount. So at that point, there is a valuation, right? Because now your company is going strong. Your investors are going to do what's called a priced round. You're going to have a valuation to your company, and they get to convert that 100,000 into an investment in that next round, but at a discount, which is usually 20% discount to the price that next round investor's paying. And same thing for if you sell the business, they get whatever the other investors, the other shareholders in the business have, but they get even more. They get 20% more for their money because they took a chance on you really, really early on. And so so sometimes, there were these convertible notes. This was the big thing. And then, but what happened very often was 1 or 2 years in the life cycle of a startup is a very short period of time. So
yeah, I was about to say that. I'm like, man, I can't imagine someone having a startup and selling, reaching that, valuation in a year or a year and a half or 2 years.
absolutely. So what started happening was, okay, your investor comes back to you like, okay, it's been 2 years, pay me back with interest. And you're like, I don't have the money to do that yet. And
Right.
so, you'd renegotiate again, more legal fees, like angst because your investors are pissed. They're not getting their money back. And so Y Combinator is a group out of Silicon Valley that developed this tool called a SAFE. And if you go to the next slide, SAFE stands for Simple Agreement for Future Equity. And it's really interesting. A SAFE is just a piece of paper that says, if and when you raise your next round of capital, this piece of paper will convert into same thing as the note, the right to buy into the next round at a discount, or the right to get extra money on the sale of the business. And so the beauty of the SAFE is, so it doesn't mature, so that's makes it a lot easier for startups. The other beauty of the SAFE is that convertible notes, there were all different terms. It was all over the board in terms of, does it convert automatically? Did the note holders get the right to decide whether to convert it? There was, again, more legal fees, trying to, a lot of negotiation. The SAFEs are on ycombinator.com. There's a form. It's not negotiable. The only, other than 2 terms. So one is, what's that discount? Which again, typically is 20%. It can be more or less, but that's typical. And then there's another term that used to go in notes and now, goes in SAFEs, called a valuation cap. And that's basically like, if you were to sell the business in the future for $100 million, what good is that 20% discount? I mean, it's still, you're still getting almost nothing for your $100,000 investment. So that caps the valuation at which the note converts or the SAFE converts, so that you still get a nice return on your investment. And the math is very complicated, and I can follow up with anyone who wants that with some examples. But so that's but that's the beauty of a SAFE. And to me, it's astounding that investors are willing to invest in this, because really they're not getting anything but a piece of paper.
Right.
But it's really common. It's really, really common. And the one thing, 2 other things I want to throw in real quick is, which it says on the slide, that if there are certain states that have these angel tax credit programs, where if the startup registers with the state, and it's a very simple process, your investors get a huge tax break on exit. And some of those programs, including here in Illinois, where I am, require the SAFE to convert. I'm sorry, to have a maturity date. So the maturity
Right. Okay.
date has to be 3 years, but you can just have a conversion at that point. So you can have a valuation done and the safe converts into, let's say, like your common stock. And the second thing I want to say is these are only good tools, these safes and convertible notes, if your plan for your business is, I want to raise money and then I want to sell in the short term. If you are starting a business and you're like, I want to run this business for the rest of my life, these are not the right tools for you.
That's a great point, and I'm glad you brought that up. Because that was the question I was going to ask: is are there times when this isn't the right option for you? And so what you're saying is that if you are building a company to eventually sell it, this is kind of the route to go. And to to fill out a safe, do you need a lawyer to kind of look over the terms, or is it from what you're saying, it seems like it's pretty cut and dry?
It's pretty cut and dry. The reason you need a lawyer is, and we'll go into this in a minute. It's actually the rest of the presentation is about why the legal things that you need to
Okay.
worry about.
Perfect.
But I'll tell you, in addition to needing a lawyer, the other thing is to be really careful about is, again, back to that, like the math. If you raise too much money on these convertible securities, you're going to end up when they convert, you're going to have given away way more of your company than your company's equity than you thought. So the other thing would be to talk to someone who is really good at that cap table math and be careful about that.
Right. Okay.
Okay, next slide. Oh, so this is the two other securities real quickly that you're going to sell once you have raised those early rounds. So you've raised on your safe round. You've typically raised like 1 to 2 million on the safe round. Actually, since I put this presentation together, I have to increase the numbers because people are raising a lot more on a safe than they used to. So now you've done that, you've got your next round investor, and let's say they're putting in like up to $5 million, let's say. And they say, like, so what are the terms you're offering me? So what most people have heard about at this point is a Series A preferred stock. And we'll talk about that on the next slide. But this is kind of this hidden secret. It's called Series Seed convertible preferred stock. And what I love about it's interesting. So your early fundraising rounds, it's very confusing, are typically called angel or seed rounds. This is the next round, but whoever came up with this still called it Series Seed Preferred. So there's actually a website, seriesseed.com. And again, vastly reduces legal fees because it's a form. There's a form of purchase agreement, and for the most part, it's not negotiated, and it's a sort of Series A light. So when you have people who come in and you give them Series A preferred stock, you're giving them a huge amount of rights in your company, including to hire and fire you as a founder, a seat on your board, just a real lot of rights. And this is an anti-dilution protection, so that if you have to raise money at a lower valuation, let's say you've raised your $3 million round and you're ready for even more, but in the meantime you need like a little tiny bridge round in there, you may have to raise at a little bit of a lower valuation. Your Series A holders get anti-dilution protection. They get a huge amount more shares. It really wreaks havoc on the founder's majority. So Series Seed does not have anti-dilution. Just a sort of it's a great in-between option to think about. And then next slide. Then there's your Series A, and I said 2 to 10 million. Probably we're talking about now 3, 4, 5 to 10 million. Now you're starting to scale, and Series A holders, as I said, get all these different rights. They get a dividend preference, so that if the company pays out dividends, they get their money first. They get seats on your board. They get registration rights with the, you have to register your shares with the SEC if they ask you to. I mean, there's just so many rights, and they're like, again, these documents are online, but there's like 4 40-page documents. and
Wow.
they are negotiable to some extent. So and you also have to pay, and with the Series C too, as the founder, you have to pay your investors' legal fees to some extent. So
Hmm.
that's why I love that Series Seed. But hopefully you get to the Series A as well, and it's okay to kind of give away the rights because you're getting a real lot of money for it.
Right. Right.
Okay, next slide. Okay, so why do you need a lawyer when dealing with all this, and what's the documentation that you need? So basically, these are securities, and the test is all the lawyers know about this: SEC versus Howey. So we call it the Howey test. So if someone is giving you money and they're passive investor, they're just saying, here, take this money, run your business, and turn it into more money for me. You are selling them a security. And so when you sell a security, there are federal and state security laws, and they say you have to file with the SEC. You have to register with the SEC, and that's like an IPO, and it's a fortune in money and time and all that. And so, of course, as a startup, that's just not something that you're going to do. And so you need to find an exemption from registration. And there are all kinds of exemptions, but the one for startups and early stage companies that you're going to depend on is called Section 4.2. And what it says is you're not conducting a public offering. So you don't need to go filing with the SEC because you're just selling privately. But the question came up like, okay, so if I have one investor, not selling to the public. If I have two, that's probably not a public offering. 3, 4, 5, like where's the scale? Like, how do you know when you meet this private offering exemption? And so the SEC came up with something called Regulation D. And if you're raising money privately, you're going to hear, everyone's going to throw that term out to you. Oh, you're doing a Reg D offering. And so under Reg D, so Reg D is a safe harbor, meaning if you comply with Reg D, the SEC says, okay, we're going to give it to you that you've got this 4.2 exemption. You're not making a public offering and you don't have to come register with the SEC. And under Reg D, there are a few different rules that you can use to comply with. So one is 504, and it's very attractive for a lot of reasons, but the states, a lot of the states don't recognize it. So I'm not going to go into it because it's less common. The most common one is 506B. And what 506B says is as long as you don't do a general solicitation, so you don't go on social media and say, hey, I'm raising money, I'll here are the terms, contact me if you want to invest.
Right.
Yeah, so you have to have what's called a pre-existing relationship with your investors. So it doesn't mean you have to have been best friends since kindergarten, but it does mean, that, your lawyer recommends them, a friend introduces you. I mean, some relationship with your investors. And then the other thing with 506B is only up to 35 non-accredited investors. And we talked about that very early on. Basically, that's someone who an accredited investor has 200,000 in income for the last 2 years with the expectation of the same this year, or 300,000 with their spouse, or totally separate test, a net worth of $1 million without counting your principal residence. And then there's some other new pieces. Those are the basics. But there's also entities where all the owners are accredited investors. There's registered investment advisors. There's family offices. I mean, there's a whole bunch of different categories now. So if you're going to take money from people who do not meet those standards, you can only have 35 under Rule 506B. And the last thing is you have to file this, what's called a Form D with the SEC, not like a registration statement, 2-3 pages. You need your lawyer for that. Want to quickly also mention an alternative is 506C, where you can make a general solicitation. You can go online, use social media, go to strangers and ask for money. But in that case, every one of your investors has to be accredited, and the burden shifts to you to make sure they are. So with the 506B, you basically give them a form and are like, check a box that as to, do you have the income? Do you have the net worth? Whatever it is. And you're
Right.
good with that.
Okay.
With 506c, the burden's on you. So there are these services. I mean, it used to be that you had to ask your investors for, give me a tax return or a W-2, and investors are not real thrilled with that. So now there's these services online that you can use that verify for you, but you have to do that. And then the last thing is crowdfunding, and that's it's the good and bad is crowdfunding is through an SEC registered portal. It's nice to have a lawyer look over the stuff, but these portals are pretty good. So I don't think it's absolutely necessary. The downside is you can only raise up to $1 million a year. You can have as many non-accredited investors as you want, but you can only raise up to $1 million a year. And then each investor is depending on their income and or net worth has caps as to how much they can invest. And the downside of crowdfunding, I mean, the upside is it's a great tool for getting publicity.
Right.
And the downside is that when I just went through an offering like this with a client, you have all these investors on your cap table, and administratively it gets really expensive. If you want to put in place like an agreement amongst all your shareholders so that they aren't selling your shares to some third party, or then it's very difficult to get all these investors to agree. And also your next round investors, like your venture capitalists, do not want to see this on the cap table because it's expensive. And because when you have these non-accredited investors, again, the SEC protects them really well. So if they lose their money and want to cause problems for you, a judge is going to be much more willing to listen to them and help them out than an accredited investor who invested in your company.
Okay. We actually have a question. Is it possible to mix these rules, or can you only use one at a time?
Oh, that's a great question. So there are actually a whole set of laws around this where, it's called integration. Like yes, you can mix them, but you want to make sure that they don't get integrated. So the SEC recently, like in the last couple of years, came up with a specific set of rules as to if you want to do a crowdfunding and a 506b together, how to structure it so that they don't become integrated.
Mm-hmm.
So yes, it is definitely possible, but within the bounds of certain law.
Okay. And in terms of, as a startup, who's handling kind of the paperwork with, contacting accredited, non-accredited? Is it usually that the startup is doing it, or they're hiring someone out to handle all that paperwork, or a lawyer's doing that?
We'll go to the
Typically,
next
what do you
slide.
see? Okay.
And I will help answer that question.
Great.
So what do you need? That's what this is all about. You're ready to, okay, ready. I get it. I'm going to sell a safe. I'm going to do a 506b. Got some potential investors who are interested lined up. What do I do? So first thing that you do is you put together a term sheet. Now, Y Combinator, if you're going to do a safe, there's a form of term sheet on their website. So again, you don't necessarily need to get a lawyer involved at that point, truthfully. I mean, if you can afford to, it's helpful, but sometimes, so you just fill in that cap and that discount, and that's it. And you can have, I typically tell people start with just a discount because that's better for the founder. And then if your investor asks for a cap, you can negotiate that in. So you can just print that out, fill in those terms, and send it to your investors, the term sheet piece. But once someone says, okay, I'm ready to invest, then that's when the lawyer absolutely needs to be involved. And the reason is that there's a second law. So there's the Securities Act of 1933 is the one that requires the registration. And there's the Securities Exchange Act of 1934. I'm geeking out on the securities laws here. And that one says, that law says you have to tell as a founder, every investor, what a reasonable person would want to know in making the decision as to whether or not to invest in your company. And so what that amounts to is basically a set of risk factors, right? So if you don't tell your investor, like let's say you're starting, you're starting to your business focuses in some area and there's a huge competitor out there, and you just don't mention that. And, your investors are like, this is super cool. And then you get killed because you have this huge, competitor out there in the marketplace and you just can't make it. And then, your investor has every right to sue you and say, like, you were supposed to tell me under the securities laws that you had this, this competitor was out there, and let me choose whether or not to make the investment. So what I draft is there's two documents. One is the safe itself, and then two, and that's just off Y Combinator. And then I do a subscription agreement. And that is an agreement that the investor signs that says, I'm agreeing to invest this much in your company. And I am not, I understand that this is, not being registered with the SEC. And so I can't turn around and resell it and create a public market because you're depending on a, private offering exemption. I'm an accredited investor, and this is why. I've had the opportunity to ask all the questions that I wanted of the founder, and they've answered them to my satisfaction. I've spoken to my tax advisors and my legal advisors, and they've all said that this is a good investment for me. I can afford to lose this money. I'm not like dependent. My family isn't dependent to pay the mortgage on this money, all that stuff. And then I attached two exhibits. Exhibit A the deck can be used in this exhibit A. Really the point of it is a description of the company. So, what's your business? What's your kind of, what makes you different and stand out? Who is your management? What are, their bios? What does your cap table look like? How much of this money you're raising is going into the founder's pockets to pay salaries, or other compensation? How are you using the money? That, that those kind of, standard, what's your plan of attack for, marketing your company, that kind of thing. 2-3 pages. And then the next exhibit is the most important thing. It's your insurance policy, and it's a set of risk factors. And it's anything and everything that could possibly go wrong with this business. And I'll tell you, like, every time I do, I have a standard set, and then we, take out for clients that, whatever doesn't apply to your business. And then we talk about your specific industry and add what does apply. And inevitably the client sees this and is like, wait, how am I going to get people to invest if I'm telling them, like, basically, we have no idea what we're doing. We're a brand new company and you're going to lose your money. And I get it, but this is not a sales document. This is your insurance policy, so that if someone loses their money, your investors, they go hire a lawyer and say, I was duped. And the lawyer says, like, well, what paperwork did you get? And the lawyer sees that you signed this document saying, I've read all the risk factors on exhibit A or exhibit B. The lawyer's going to say, I'm not representing you because this company did everything they were supposed to do, and you're going to lose. So, I mean, you can always get sued. I guess some lawyers will take, but this is, I've never, and I will knock on my wooden desk, in 30 years, had a client get sued because I'm so crazy over having these risk factors.
Right.
So that's the stuff that where the lawyer is really necessary. Sometimes I will say, when you're going to like a really sophisticated angel investor group, they're going to say, like Chicago Ventures here and Chicago Hyde Park Investors, they're going to say, we're not signing that. And that's okay, because they are sophisticated enough to do their own due diligence on your company, and they know the risk they're taking, and the courts know that they know the risk they're taking. So you're okay in those circumstances. Two other really important things I want to mention here that are on this slide. So one is paying finders. This is, I probably at least once a week run into this. There are people out there who will tell you, I've got this huge network of investors for you, and if you give me a percentage of what I raise, I'll take your deck and help you raise money. And that is illegal unless that person is a registered broker-dealer. And the biggest problem you have as a founder is that if that person is found to be in breach of the securities laws, you are also in breach for aiding and abetting. So it's really, really, really important. And, now if someone does it one time, like you meet someone and they're like, I'm in the industry, right? This is entertainment, right? I'm in the industry. I've got some big players who would love this concept. I'd love a percentage off the top. If they don't do that for a living and they're doing it just to help you one off, you can absolutely do it. But if someone like this is what they do for a living, or it's, 2 or 3 times they're doing it for a bunch of different companies, you have to be really, really, really careful about it. So it's deeply troubling because there are many people who say that's just ridiculous. Like if someone's willing to help me out finding investors and I'm giving them all the disclosure and all that, like why shouldn't they be able to make money from it? And there
Right.
is legislation out there that was out like it's been out there like 3 years that says that is going to allow this to go on, but it's going nowhere because of the people who are protecting investors and are like, I don't want these unscrupulous people coming out and getting paid to bring investors to the table. So that's huge.
We have a question too. Is there a way of having a non-licensed broker to help?
Well, if they don't do it for a living is one.
Mm-hmm.
And then the other way is it's a really interesting, it's like there's like a 5-factor test that goes into whether they're acting as a registered broker dealer. So the biggest factor in there is, are they taking a return? Are they being compensated based on how much they raise? So there is like, if you do like a, $10,000, I've seen a $10,000 fee a month and we'll help you put your deck together. We'll help you learn to pitch, all that. And we'll make some introductions for you to investors. That's usually fine. It's the structuring it where the compensation that you pay is based on a percentage off the top of what's raised.
Great. I love the questions coming in. Keep them coming. Yeah, that's a great clarification. I know that especially for startups and founders, the network of fundraising is huge, right? It's like you want to meet people that know people. And so kind of navigating that in a way that doesn't get you in trouble is really important.
Yeah. Yeah. And then the last thing I'll add, from the slide is that there are state laws that go along with all the federal laws that I talked about. So that's another place where the SEC, where a lawyer comes into play. So the lawyer will want to file that Form D with you with the SEC. And then that Form Ds, a lot of states require that form to be filed with them as well. It's really a way for them to bring in fees because they charge a fee along with it. But the law that governs is where your investor resides. So, like for instance, Florida has no filings required at all. Illinois, if all your investors are accredited, no filings. Otherwise, you have to file your Form D with the state of Illinois. And there's an electronic state database as well. And it's $100 fee. All these filings are due within 15 days after the first sale to someone in that state. The only caveat to that is New York, which requires the filing to be made before you even make an offer to investors who reside in New York. So just stuff to keep in mind.
Yeah. And we have one more question about the money finder. What type of
Sure.
structuring of compensation is proper with a money finder?
Well, there's a couple things. I mean, there's flat fees is the only one I can tell you is 100% fine. As long as you meet the other tests, which are like not getting involved, like making introductions to the investors, but not getting involved in the negotiations. There's a few other factors. That's one of them. There are people who have ways of getting around. I know someone who in Chicago who ties it to who does this for a living. They take a warrant, and the amount of the warrant is tied to the number of shares outstanding after the raise is over. It's very creative. I'll tell you that this person used a large, very well-known firm to craft this, and they feel comfortable that meets the law. I mean, I don't opine on those things because that's not my specialty,
Right.
but yeah, that's the best I can answer that.
Okay.
So yeah, this is back to the documents that I would put together, that a lawyer would put together for you. And we already talked through those. So let's see what's on the next slide. Yeah, I think this is the last slide. And this is just back to that, if you do that crowdfunding, having this large pool of investors, some of the problems, something you should know is like, if you sell shares in your company, and this is less for those convertible rounds, but once you give someone stock in your company, something to think about, they have all kinds of rights. And so they can ask you to inspect your books and records. They can bring a claim against you on behalf of the company where the company has to pay legal fees. It's you just have to be really careful about giving out equity. And another thing I'll tell you is that I've just seen a lot lately, a lot of new clients who, anyone and everyone who helped them, they would say, "Oh, you've been so great. I'm going to give you 1% of equity in my company." And they would, throw it in an email. And then that person maybe disappeared. And then, now they're going to raise money from institutional investors. And that person has a right, to come back at some point and say, like, wait a second, I have 1% of your company. So we're helping these clients clean up that mess. And it's really expensive.
Right.
And venture capitalists, when they're giving you a real lot of money, they want that cleaned up. So, just be real careful about that. There may be one other. Is there one other slide?
Let me check.
Oh, yeah, this is something, I just think this stuff will be helpful. So, because it's just questions I get a lot from early stage companies. So, founder shares, things to think about. Investors like to see founders' stock vest over time. So instead of giving yourself, X number of shares, and saying, I own these in full, what that means is that you own the shares, you can vote them if the company paid dividends, which, a startup's not going to pay dividends, but you'd be entitled to them. But if you leave the company, any shares that have not yet vested, you lose. So usually we call it a 1-year cliff. So you give yourself, let's say, 2 million shares in the company. So this is another question that might come up. So if you're raising serial rounds of capital, you're probably going to want to form a Delaware C Corp. And the way that I divvy up the equity is Delaware has this franchise tax, and it's very complex how it's determined. And so you have to make sure you authorize and issue the right number of shares with the right par value. So what I would tell you is you authorize 10 million shares, 0.0001 par value per share. You issue to the founders a total of 4 million shares, and you put 1 million shares aside for what's called an option pool. And that's, shares that are equity that's available to incentivize your advisors and your employees, to stick around and be part of the company. And so those 4 million shares, you divvy them up amongst the founders. So let's say you're a founder and you have 1 million shares. 25% of those shares would vest after the first year of being with the company, after they're issued, and then an equal monthly amount over the next 36 months. So let's say, you have a co-founder, and a year in, you guys are not getting along, and the co-founder exits the company. 25% of their shares have vested. They own that stock. So another big thing for me is that I'm like very, very important to me with my clients is that you build in a right to buy back that stock. And that's because I had an experience with a client very early on where he gave stock to someone who came on, and those vesting parameters are also good for shares that you give out of that option pool to your advisors and employees. So he brought on someone and thought she was like God's gift, and she was like a chief sales officer, and he gave her 10% of the company, and it vested over time. And the first year went great. So now her shares have vested, and things don't work out. And they really are, she leaves on bad terms, right? So she loses 75% of her stock, but she's got 25% of that 10%. And she proceeds to show up at every annual meeting. I mean, companies don't even usually have an annual meeting. They do like a written consent, but the law requires you put notice out there. So he had to give her notice every year, and she'd be like, I'm coming to your meeting. And then she would come to the meeting and like, why are you using the money that way? And why are you, and just caused such trouble. And it was emotional. It was time consuming. It was legal fees. And so, having that right to buy back stock, even after it's vested, you have to pay fair market value, so if your company's worth a lot of money, it may cost you, but it's certainly better than having someone out there who you don't have a great relationship with.
Right.
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 And two other quick things I'll throw in. So when you issue vesting stock, you want to file what's called a Section 83B election. So the tax laws say that if your stock vests over time, you don't pay taxes on it until it vests. So when you first are, founding a company, there's no value. So you're not getting a tax hit. But then let's say, 3.5 years from now, hopefully your company's worth money and now you've got shares vesting and you have to pay taxes on them at that value. So by filing the 83B election, you lock in the value at the date of grant for all the shares for tax purposes. So you basically have no tax. So that's a really big deal. You must file it within 30 days of issuing the shares. There's no exceptions to that. So something really important to keep in mind, and to tell any of your advisors who you incentivize with stock, you want to let them know that they got to file that 83B election as well. If you have 50-50 ownership with your co-founder, you must have an agreement with each other. You will, if you don't agree, you'll hamstring the company and it will, be a huge problem. So that's something else really important. And then the final thing that I get asked a lot about is, if I'm going to incentivize my early advisors with equity, don't I give them stock options? Like what, and the answer is, when you have no value, again, you can give them straight what we call restricted shares. So shares that vest over time. You switch to stock options once there's value, because again, they're not going to want to take a tax hit. So then you switch to a stock option, which gives them the right to buy your stock at a price based on the valuation of the stock on the date of grant. So let's see if we have more questions. I know we only have a few minutes left, so I'll stop there. That was a lot. So
Yeah. No, I mean, it was fantastic, and I'm actually just really excited that I'm connected with you, because we have a lot of people coming through, and just hearing your experience, and also just all of the details and the important things that people need to think about to protect themselves. At these early stages, from some of the examples you were saying, can get messy.
Yep.
So it's important to just kind of take the right steps. I'm gonna put your website below, All Rise Lawyers. Obviously, connect with Leslie if you want to talk to her. You can reach out to me. And if we have any more questions, we do coming in. Let me see. Is the 83B option something the company does or the individual does?
It's the individual, but I usually, just to be nice to, your advisors you're giving equity to, I usually attach the form to the restricted stock agreement that you're giving someone. Just, makes it easier for them, reminds them to get it done.
Great. All right. Well, Leslie, I know that you have a 4 o'clock, and I really appreciate you taking the time to talk to us today. I learned a ton. It's great to see all the questions that came in. And I hope that we'll stay in touch, as we have startups coming in all the time who are building things, in terms of who do they need to talk to? They need to talk to you.
I actually have a startup for you. I spoke with yesterday. I mentor a lot, and
Yeah.
they're in the entertainment industry and wanted to be connected with you. And anyone who's viewing and has a quick question, I am always happy to talk. I do free initial consultations. So, even if you have another lawyer and you're not going to retain me and you have a quick question, you need a second opinion, just reach out.
Sounds great. All right. Well, that's it for now. Thanks again, Leslie, and we will talk with you soon.
Thank you.
Well, there you have it, everyone. What an incredible presentation. There's so many details and things that she talked about that are important when, starting the funding for your company, these early stages, things to be thinking about. Obviously, if you listen to this whole presentation, you're like, you can see why it's really important to find the right counsel in these situations. Again, my name is Daniel Crane. I am the program director for the Center for Creative Entrepreneurship. You've been listening to one of our workshops that we host online. If you go to cceglobal.org, you can check out all of the events that we have going on, some live, some virtual. We also aggregate our partner events as well and cover all types of subjects, including legal, marketing, business, small business administration stuff, general business acumen, and sector-specific things, whether you're in film, music, music tech, all types of different things. So again, check that out, cceglobal.org. We thank you for listening, and we will talk with you soon. Take care.